Hey everyone, it's Daniel here from etfs. Hope you're all doing well. So I have an article here. It's pretty interesting. The title says Biden to push good credit home buyers to subsidize high risk mortgages. So the article, I'll read it here for you and I'll link it in the description so you can follow along. But it basically says a new rule from the Biden administration will force home buyers with good credit scores to pay higher mortgage rates in order to subsidize loans to those with riskier borrowing profiles. So pretty weird way of trying to lower the sales and try to fix the housing crisis and the shortages. What they're essentially trying to do is add a fee and make it harder for people who have a good credit to go out and purchase. Makes sense. However, they're using those fees to subsidize the ones with a higher risk profile, saying that, yeah, sure, no problem, you could purchase. You have a lower credit, no problem. But the ones with the higher credit, we're gonna slap a tax on you or a fee on you, and make it more difficult for you to purchase. So moving on, the fee which will apply to those buying or refinancing houses after May 1st. Now, this is not only for buying, but refinancing after May 1st is going to affect home buyers with credit scores of 680 or higher, will amount to roughly $40 per month on a home loan of 400,000 or nearly $500 per year. Home buyers who make a down payment of 15% to 20% will be hit with the largest fees, right? So if you think about, if you're refinancing, you have to refinance and you're hit with higher fees. I mean, that's just going to make it even worse for you. Whether it's $500 per year or more, it's going to make it worse for you to sustain that, especially with what is to come, right? The recession, the market uncertainty, the higher food costs, bills, etc., etc. It's just making it worse off. And when you look back at the crisis, right, the 2008 crisis, it wasn't only just bad credit that had a problem. There were people with good credit that also went under, and it was because the good credit individuals, they were buying a lot of homes and they were over levered, right? So they had way too much leverage in the markets, in the real estate market, back in 2007, 2008. And when the bubble basically bursted, right, those people with the best credit ended up defaulting also, right? So it's not just bad credit here they have to be worried about. It's the over levered individuals, no matter what your credit score is, good or bad, that can end up being a very bad situation for that person. Right, so when we scroll down here, we see that, okay, under the Biden rules, those with lower credit scores and smaller down payments will qualify for better mortgage rates and discounted fees. So if you're getting, ones with lower credit scores to get into the housing market, and then all of a sudden you have this big spike of unemployment rate, and especially for them who have already tough times and troubles in the current market, what do you think that will look like if we get the unemployment rate to really spike and massive job layoffs start to show up, right? Let's not forget the tech companies have been laying off drastically. We had also news of McDonald's coming out, right? McDonald's, did you think of a recession stock coming out and saying that they need to lay off workers? It's definitely not looking good in terms of what can come in the future. So if a lot of these people, especially the lower credit score individuals, get in, it could set up for a big hard landing, especially if things start to deteriorate very, very quickly. So let me know what you guys think about this article. I'll leave the link in the description for you to read up on it. Comment below your thoughts, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.